Good evening, ladies and gentlemen. This is Barry Norman for investing.com, and welcome to our class tonight on robotic trading, algorithms, and quants. Now, tonight's webinar is being recorded. Okay. Now, we will, or investing.com, I should say, will send you an email with the link when the class is prepared, edited, uploaded, and ready to go. I've been asked by customer support to please ask you to not call them, chat. We will send this to you. But we do, some days we do as many as 15 webinars because we're doing many languages, and they're getting barraged with these questions, and they can, the guy who's responsible for putting them together, uploading them, making sure they're edited all right and getting them out, it takes a little bit of time. And so a lot of you guys are swamping customer support. And I promise you, we know everybody who's enrolled in the webinar, everybody's attended, and they will, as soon as it is ready and that they have it ready, they will send you a link so that you can watch it at your convenience over and over and over again. Okay, so like I said, tonight's class is being recorded and you will receive an email with the link. Now, you might want to start using algo or robotic trading. It's a great way to trade. Now, I know a lot of people, when you mention the word robotic, think of scams and ripoffs. Okay. Other people, when you mention the word algorithmic or quantitative, they get scared because they think it's very complicated, or it's huge mathematical calculations that require lots of computer development and lots of technical skills outside of just trading. But the fact is, it really isn't that difficult anymore because all the new systems give you this stuff that's pre-programmed. Okay, I use robotic trading, but I don't ever let anybody make a trade on my behalf. Okay, whether you have it hooked up to a platform and allowing it to trade is a completely personal decision based on your own risk management and your own personality. Okay. But you can have them just as scanners that are scanning the markets looking for specific chart patterns, or scanners that are looking for specific indicators or market actions and reactions, because these automated trading programs can watch the markets a lot closer than we can. They can look for these inconsistencies in the market or look for specific happenings and analyze them based on what you've determined you want to use for your analysis, and alert you to these because they are much faster than the human capability. And the markets are getting faster and faster. And just trading with fundamental analysis or trying to trade things on charts, if you want to deal with only one or two assets, that's perfectly fine. But when you're dealing with a full range of assets and you're trading, whether you're trading stocks and day trading, whether you're trading currencies or you're trading commodities or you're trading CFDs, somebody has to be constantly looking and searching for profitable situations. If you're looking for a stock that is available, then you do not, or you're saying you're trading the energy sector. You don't have a time to watch all of those stocks. You need somebody scanning for this. If you're only looking to make trades that'll make you 20 to 30%, you've got to be looking for assets that are moving. Well, you could do this, spend lots and lots of time, or have an automated system doing this for you. So whether you're calling it algorithmic or quantitative or quants or robotic, it's up to you. Okay, there are slight variations, but in the overall scope of things, they mean the same thing. But the definition of a trading robot is a computer program based on a set of trading signals that helps determine whether to buy or sell an asset at any time. Robots are designed to remove the psychological element of trading, which can be very detrimental. And that is extremely true because too many times we know the right thing to do, but we do the wrong thing because we get involved in it, because of our own market prejudice. Okay. Now, automated trading robots are available for traders to purchase over the internet. It is important to note that there is no such thing as the holy grail of trading, okay, whether automated or not. If the automated system is being sold was a perfect moneymaker, the seller would not want to share it. This is why big financial firms keep their black box trading programs under lock and key. And if JP Morgan Chase, Merrill Lynch, all of these today are using robotic black boxes. And a black box simply means it's a robotic trading system, but nobody knows what's inside because they don't want other people duplicating it. So it's boxed, but they are constantly adjusting it and correcting it and testing it and back testing it. Okay. And they have many different ones depending on market and risk tolerance. Now, there are many automated day trading systems and signals are available too to purchase over the internet. Now, when you see people offering you free robots to make a fortune, okay, they're offering free this or they're broke, these are things you should be going away for. Or they don't want to tell you how their system works, what it's done. If they just say you have to follow it and just do it. Because today, most of the automated systems or the indicators and the AIs you buy are customizable, where you can adjust them. You can make your own, you use their programming and it all runs, but it gives you, some of them are very simple. It says, do you want to use this indicator, this indicator, and you just click off the boxes. It's already figured out. But if you want to combine it with RSI and you say you decide RSI, you don't like the 0 to 30, you only want it when it's 0 to 5. Okay, you can override it and put that in so it's doing exactly what you want it to do. Okay. But today, they will scan the markets for you because keeping track of everything happening in the markets is virtually impossible. And you need to find the best trading scenarios possible. Now, trading systems can be either manual or automated. A manual system involves sitting at a computer screen, looking for signals and interpreting whether to buy or sell. In an automated trading system, the trader teaches the software what signals to look for and how to interpret them. It is thought that automated trading removes the emotion and the psychological component of trading that often leads to bad judgment. Both automated and manual day trading systems and signals are often available for purchase. And I've given 2 handouts to you in tonight's class. And these are 2 handouts of just some of the range of things that are available to you. If you're trading on an MT4 platform, MT5 platform, they have thousands of apps that are already developed that can be built right into their AE system, and you can use them and you can decide whether you want them to trade on the platform for you, or they just want to give them signals. Okay, all of this is available today. Okay, but if you think about it, all it is algorithmic trading. It's using oscillators and indicators or trend patterns that are put into numeric values and told to do something. Okay. Now, any trader can use trading robots and indicators in their day-to-day activity. There are special applications for trading platforms, and their use does not require any specific knowledge or programming skills. And that's the nice part. A lot of this stuff is on the markets, and you don't have to have any programming at all. And you don't even really need to. Some of them you can buy pre-packaged, and you can just follow along with them, or you can slightly tweak them, or others, you can buy one that just gives you signals from, say, MACD, one that gives you this, and you can put them together. And it's not very complicated because everything's pre-programmed for you. Now, you can download an application and buy or rent one from the market or order it via the freelance service on MT4. Finally, if you're not always looking for a simple solution, you can develop a custom robot or indicator by yourself. Now, to be honest, I'm trying to do this with 2 friends at the moment, and we're finding it so complex and so difficult and so time-consuming that we're now looking for a customizable one in the markets that we can then customize with our own rules. Because I'm not a coder. I don't know, how to write language, and then when you have to write it, you have to write every little specific rule. When this happens, do that, and it all gets complicated. But there are free source libraries out there of robots and indicators, which is built directly into some platforms. There you can select from, there's almost 2,000 indicators that are already available, pre-programmed in the marketplace, and 950 different trading robots. Okay, so there's tons of stuff out there. The library also consists of 300 scripts, which are small applications allowing to automate one-time analytical trading functions. All you have to do is learn how to put them together. Okay, now, if you're trading on an MT4 platform, you have all of the stuff that's already done for you. Now, again, they're all customizable. But even today, you can even, if you're using just TradingView charts, okay, the free TradingView charts, you can go on, and I'll show you in a minute where traders have developed their own systems, and you can actually add it onto your charts automatically, free of charge, and then customize them and use them on your charts. And use this because all it's doing is scanning the markets or giving you information quickly. Okay. Now, algo trading consists of whether you want initiation prices, whether you want quantity order types, you can look at profit targets, you can look at telling it to have trailing stocks, you can set it up with exit prices. You can do whatever you wish. And this is the amazing thing about algo trading, quant trading, or robotic trading today, because it isn't buying this canned package that just going to trade for you. You decide where you want to be. Okay? Instead of spending your time learning, say, technical analysis and spending hours and hours and hours with charts, you can spend your time fixing your algorithmic trading system so it does it all. You don't need to sit there and keep looking at RSI and stochastics and MACD and looking at, there's even ones with simplistic that we'll look at trend patterns and trend action. Like there's things like AutoChartist that is constantly monitoring, scanning the markets for specific action to trends. Okay, when a price bounces off of a trend line, when a price breaks a trend line. You have other ones that are looking for chart patterns. Now, before you decide, you do need to understand. Now, you can download complete trading systems. You can have customizable trading robots or systems, or you can build your own, or use one on your platform. Or you can download, program, and code for each indicator you want. Design your own system. Okay. Now, algorithmic or quantitative trading is a technical subject. Hence, it requires some understanding of mathematics and programming. However, it has become substantially easier to get started in the last few years. Algorithmic trading involves a scientific approach to designing trading strategies. It makes use of quantitative tools such as statistics, time series analysis, machine learning in order to produce net profits above any transactional cost over time. In addition, it is necessary to know how to program via a language such as Python or C++ in order to carry out research. Okay, so it's a little bit scary if you want to start on your own. Now, there are lots of choices. In the handout I gave you, you can see all of these simple little systems that are already designed. Some of them are customizable, and you can just start using them now. They're not free. You have to buy them. Some you have to rent. Okay, but it saves you all that time, and it allows you to then, like I said, adjust them to fit your style of trading. Now, an algorithmic is a specific set of clearly defined instructions aimed to carry out a task or a process. Now, somebody just asked me, are you talking about Forex market robots? I'm talking about all market robots. Okay. A robot is a robot. The final decision in the final rules you're talking about is if you're saying if this reaches that and this does this and this does that, doesn't matter whether you're using MACD on the euro or you're using MACD on oil or you're using MACD on a stock. Doesn't make a difference. It's the final determination of the buy and sell, the stop loss and the take profits that has to be then applied. But I'm not even talking about automated trading robots, okay? Because to me, to allow a robot to trade your money isn't what the market's about. Because then I'm just giving my money to something that's gonna waste it for me. Okay. I always believe the final step in the whole matter is the human quantity that makes that final determination before you push a trade button. And it doesn't matter what market you're in, it still follows the same rules. Okay. Now, algorithmic trading or automated trading or black box trading or simply algo trading is a process of using computer program to follow a defined set of instructions for placing a trade in order to generate profits at a speed and frequency that is impossible for the human trader. Now, there are lots of people that are using these type of robotic trading that are making huge amounts of small little trades and making little bits of cents. Okay. I've never used one, but I do hear that they work. You have to determine your risk strategy. And determining your risk strategy and how much you can invest and how much control you want to have is up to you. But again, if you're looking to make hundreds of little trades that make a couple dollars here, a couple dollars there, these systems can do it for you. It's your trading style. Okay. Quantitative trading isn't accessible solely to institutional traders. Retail traders can get involved as well. While programming skills are recommended if you want to produce algorithms, even those aren't always required. Programs and services are available that write the programming code for a strategy based on the inputs you provide. The code produced by the program and service is then plugged into a trading platform and trading commences. So you have many choices. You can either buy pre-written ones. You can also establish a set of rules through a system and then it will write the programming for you, or you can write your own from scratch. But before any of this can occur, a wannabe algorithmic trader progresses through several steps deciding exactly what they want to accomplish with algorithms and how. Okay. Humans need to stay involved. While a well-programmed algorithmic system can run on its own, some human oversight is recommended. Therefore, choose a time frame and a trade frequency that allows you to monitor. If you have a full-time job and your algorithm is programmed to make hundreds of trades a day on 1-minute charts while you're at work, this may not be ideal. You may wish to choose a slightly longer term time frame for your trades and less frequency so that you can keep tabs on it. All quantitative trading processes begin with the initial period of research. And this is what some of this takes out of the market. If you can buy a pre-programmed algo or robotic trader that, and they fully disclose what everything is built on and that you can customize it, you can take a lot of the research out of it. But I still don't trust anybody. Not that I don't trust them that they're trying to deceive me. Is markets change. People tell you they're successful 500 times in a row. Well, I don't want to start out in the next 100 times they're wrong before they get back to the 500. Okay. So I believe in understanding it all myself, adjusting it myself, customizing it myself, and then back testing. And back testing and testing is the most important thing because a lot of these trading algorithms are you can rent. And then you can fully determine whether you actually want to use it. You can back test it and tell them, hey, this wasn't successful in my back testing, so therefore I'm not going to pay any money for it. Now, obtaining any data necessary to test a strategy and trying to optimize the strategy for higher returns or lower risk. You will need to factor in your own capital requirement of running a strategy as a retail trader and how any transaction costs will affect that strategy. Now, contrary to popular belief, it is actually quite straightforward to find profitable strategies through various public sources. Academics regularly publish theoretical trading results. Quantitative finance blogs will discuss strategies in detail. Trade journals will outline some of the strategies employed by funds. You might question why individual firms are so keen to discuss their profitable strategies especially when they don't know others and are crowding the trade and may stop the strategy from working in the long term. The reason lies in the fact that they will not often discuss the exact parameters, okay, and tuning methods that they have carried out. These optimizations are the key to turning a relatively mediocre strategy into a highly profitable one. In fact, one of the best ways to create your own unique strategy is to find a similar method and then carry out your own optimization procedures. And this is the most successful of them all, is finding a prepackaged program or downloadable program that you like, that has the indicators and the oscillators and the patterns you feel comfortable with, and then optimizing it. And a lot of these will have, like I said, customizable or optimization features where you don't have to do anything. You're just ticking off boxes, changing numbers, and doing all this, and it factors it right in there. And then then it becomes your trading system. Okay. Now, here's a list of places to begin looking for strategy aids. And it's up on the screen, but I also gave it to you in the handout. But these are quite unique strategies that work very well in algo trading. But you have to at least have some understanding of where to begin. Okay. Many of the strategies that you will look at will fall into categories as means reversion or trend following or momentum. A mean reversion strategy is one that attempts to exploit the fact that a long-term mean on a price series, such as a spread between two correlating assets, exists, and that short-term deviations from this mean will eventually revert. In other words, look at the spreads. There's whole robots that are based on the spread between crude oil, Brent crude oil, and WTI. And sometimes the spread is very close, and sometimes the spread widens. And there's points where that spread, when it widens, it will come back into focus, or when it gets reversed, like during a couple of months ago, before the Saudis just did what they did recently, that WTI was trading at a higher price than Brent crude oil, which is really unheard of. Okay, and that would have signaled a perfectly good time to buy one and sell the other. And then as that spread widened, you would then exit the trade. So this is what the markets can look for. And this happens sometimes not in a week. It happens in a couple hours. Okay. Then there's short-term deviations from this mean that will eventually revert. A momentum strategy attempts to exploit both investor psychology and big fund structures for hitching a ride on a market trend, which can gather momentum in one direction and follow the trend. But you have to figure out what type of strategy you're looking for, because you're not going to just go out and buy or rent many, many robots, and you have to decide exactly. You've got to spend some time figuring out what you want to do. Another hugely important aspect of quantitative trading is the frequency of trading. Now, personally, I don't believe in high frequency trading. There's nothing wrong with it, or ultra high frequency. It just doesn't fit my style. Okay. I want something that's going to evaluate the assets, feed me back something, and give me time to make my own analysis and then trade it. All I want something is scanning the markets, continually looking for the specific patterns and indicators based on what I've told it to do. So while I'm teaching class, it's doing that, and something's popping up on my screen and telling me, here's a perfect trade opportunity, do this now. Okay. You can have other ones that will set your stop loss and your take profit points, do the whole trade for you. But I'm just not comfortable with that. Doesn't mean you won't be comfortable with that. Okay, and there's no wrong about it. It has to fit your personality. But the biggest clue at all of this comes from what we call backtesting. And algorithmic trading is heavily reliant on the concept of backtesting. Backtesting is the application of predefined trading rules to historical data. This allows us to estimate how a trading strategy might have performed in the past. It also provides us with evidence that such a strategy may be profitable in the future. And today, again, because of a lot of backtesting website providers, you can take your strategy, make the tweaks you want, and then run it through a back testing system, which will instantaneously run it through the last 6 months of the markets and show you how successful it would be or what your failure ratio would, and then you can keep adjusting it. So there's backtesting systems like Quantopian and Quant Connect. These platforms eliminate the need to spend months or years developing your own research and trading infrastructure, as well as connecting and cleaning years of historical data. And you simply allow to get going, because you can, once you've tweaked this, you simply upload it into you hook it up with their data and the two things together. There's no hooking up. You can just click a couple buttons and it will run it through the historical data for you and give you the results, and say, oh, look at that. You know what? I shifted it from the manufacturer or the developer gave, and my shift was very bad. Overall, I would have lost. So you go back and tweak it again, run it through again, and you can keep doing this. Now, the goal of backtesting is to provide evidence that the strategy identified via the above process is profitable when applied to both historical and out-of-sample data. This sets the expectation of how the strategy will perform in the real world. However, backtesting is not a guarantee of success for various reasons. It is perhaps the most subtle area of quantitative trading, since it entails numerous biases which must be carefully considered and eliminated as much as possible. We will discuss the common types of bias, including look-ahead bias, survivorship bias, and optimization bias in another class. Other areas of importance within backtesting include availability and cleanliness of historical data, factoring in realistic transaction costs, and deciding upon a robust backtesting. Now, what happens is a lot of people who are using high frequency and ultra high frequency, their profit doesn't exceed their costs. So the trade was profitable, but their costs outweighed it, and at the end of a week, they find out, well, they made lots of little bit trades, but by the time they subtracted the broker's costs, processing costs, or commissions, and the rental of the robot, they had actually lost money. Okay, somebody says, some robots change their data, and when you see past, it seems that they were right, but they were not. Okay. This is what a provider provides you. Your job isn't to use their data. Your job is to take their robot and to put it through a backtesting service, independent. So it becomes your data and your historical data, not what the guy is selling you. Because yes, it's just like buying a used car. The guy isn't lying to you, but he's exaggerating. Okay. Or it's very easy to take 2 weeks to the marketplace when you knew the dollar was going to be up and run a whole bunch of tests and trade the dollar to go up. It's just like anybody didn't need a robot for the last 2 weeks to trade oil. Okay. It was an easy thing to do. Leading up to the Federal Reserve and Donald Trump's victory, to trade the dollar going up wasn't a very difficult accomplishment. So if you ran a robot through it and said, well, here's my results, and it made 1,000 trades over the last month, they were all profitable, well, hopefully you would have made those same decisions yourself. Okay. But backtesting is very, very important, and you do it independently. Backtesting isn't a matter of using what the robot told you that their success rate was or what their trades were. But you also have to remember, depending on where and what you're trading and who you're trading with, because the robot can't factor in your broker's spreads. Okay, they might have been testing it through a broker who had a tighter spread, or spreads also change during different types of time. Okay. Once a strategy has been identified, it is necessary to obtain the historical data through which to carry out the testing and perhaps refinement. There are a significant number of data vendors across all asset classes. Their costs generally scale with the quality and depth and timeliness of the data. The traditional starting point for beginning quant traders, at least the retailer, is to use the free data set from like Yahoo Finance. I won't dwell on providers too much here. Rather, I would like to concentrate on general issues when dealing with historical data sets. Okay. But there's very good, like QuantShare offers an excellent backtesting tool. Okay. They have everything, and you can run your strategy right through that backtest like its current market, and you'll see exactly what the results were. And this allows you to run a lot of testing in a very short period of time. So in other words, what would have taken us before weeks or months of testing a strategy before you even get to tweak it, you can now do it in a matter of a couple hours, and then you can tweak it later and tweak it and tweak it and tweak it until you get it right. It just simply allows you to use historical data and run your determination through this back testing and optimize it. And there are, as many people are selling you the indicators and the robots and the algorithms is just as many people selling you the back testing stuff. Okay, but QuantShare and Quantify are like the two of the best, and they will give you the most successful answers and the fastest answers and let you move forward. And it's not very complicated. You have to do the work, but there's no way that you're going to make money without doing some work. Now, QuantShare is a desktop application that allows you traders to monitor and analyze the markets. You can display charts and add indicators, create watch lists, create trading strategies, backtest these strategies, and create portfolios based on these strategies. QuantShare is suitable for all levels of traders, and it works with U.S. and international markets. So for those of you who are asking me who I would have recommended or where I would have recommended you starting out, this is a great place to start. Okay, because not only for backtesting, you can use their system to build your strategies and do all of that on your own. QuantShare is for trading and investors who want to create and analyze charts and studies and indicators, create backtesting trading strategies, analyze data and perform quantitative research, create watch lists and screens. And with QuantShare trading software, you can access the trading items shared by our members, and this includes downloaders, watch lists, and everything else. It's a great place to begin if you want to really build your own strategy without having to build the software. Okay. But don't set and forget. Algorithm trading isn't a set and forget endeavor that makes you rich overnight. In fact, quantitative trading can just as much work as trading manually. If you choose to create an algorithm, be aware of how time, finance, and market constraints may affect your strategy. At different markets require different strategies. You'd be surprised. Strategies that work one day may not work next month because the markets are different at that time. Sometimes you have volatile markets. You have strategies that work in range markets. You have strategies that work in down-moving markets. You have strategies that work, the strategy you'd be using today would be much different than what you would have been applying successfully during the financial crisis back in 2008. So if you choose to create an algorithm, be aware that how time, financial, and market constraints may affect your strategy and plan accordingly. Turn a current strategy into a rule-based one which can be easily programmed, or select a quantitative method that you have already been tested and researched. Then run your own testing phase using historic and current data. If that checks out, then run the algorithm with real money under a watchful eye. Adjust if required, but otherwise just let it do its job. Now, what it does is anything, whether you're using quant trading, robotic trading, you're using algorithmic trading, it empowers you. It's intuitive, it's powerful, and it allows you to scan a lot of markets that you couldn't normally do on your own. So I'd like to thank you for joining us tonight. I hope we gave you something to look at. Now, I want you to stay with us for a minute because I'm going to try something. And I'm telling you now, I've never done this before because it just became available with the GoToMeeting software. And it allows me to run a video in the class. And I'm going to try to see if this works. And I can't carry because I've uploaded them and got them already, but I've never done this before. It's new and beta testing with them. And so I'm going to try to run this video. And I just want you to hold out. It may crash. It may not work right. But let's see what happens because I would like to see I just want to see how it works for everybody. So let's do, thank you very much for joining us tonight. And hopefully we'll see you at, we have a whole bunch of classes coming on this month. Next month we have a whole bunch of new classes. We're doing a 2-week course in Elliott wave patterns. We're doing a 2-week course in swing trading, and we're doing a 4-week course for beginning technical analysis. We'll start out with charts. We'll move over to trend lines. We'll move to chart patterns. Then we'll move to adding indicators, all, an hour for each one, so you should be an expert at the end of them. Okay. So thank you very much, and have a great trading week. And thank you for being part of the investing.com family. Have a wonderful night now. Bye.